Hey everybody, I am here in the process of resharing my screen. Please bear with me. Okay, everybody, we should be back to be connected normally. I would appreciate if you could give me a confirmation on the comments box so I know you hear me, so that way I can proceed and continue normally. Okay, guys, I just need to have you confirm that you see me. Would be important that you give me that confirmation so that way I know I can continue. Okay. Yes, thank you so much, Carl. Yeah. Well, I have to apologize one more time for this issue, but it's good to hear that you guys are back to be connected. 1 second, guys, because we still have a few of the attendees connected to the other stream. Yeah, good. So I guess we will be fine to continue and finalize our session, okay? Guys, let's keep going here. Sorry for the little interruption, okay? But let's keep going. Let's not lose the focus on what we were doing because we're going to hit the important part of today. So, so we are now planning to buy a call instead of going long shares of that particular security, which is an ETF. And the two questions we have in front of us is which one? And I said two questions because to answer which one, we need to look at which expiration date and which strike. So there are two things that need to be defined to be able to answer that question. Okay. So let's go ahead and look at that. Okay. And by the way, in this case too, first example that we pick, we're gonna have a little bit of an exception because one of the rules for the expiration date is to look at earnings, but because this is an ETF, there are no earnings. Okay. So if you don't mind, I'm just gonna try to find another example to make our first example to be a little simpler. So we'll look at LRCX. We'll look at LRCX, and you know the green UFO is very far away. So look at American Express. Sorry, MasterCard. I know what I was thinking. And so what's happening with MasterCard? Let me see where we're at. Okay, so we are about to make all-time high. That's why we have no red UFOs. Procter & Gamble. So where are we at? Looking at the monthly time frame, yeah, making all-time high with Procter & Gamble and UNP. Okay, just looking at my options first. Yeah, got it. So definitely, the clearest example was KRE. Okay, but I'm gonna go ahead and use MA just because I would like to use a stock in this first example, not an ETF. It's going to be easier for us to understand. Okay, so I'm just going to move this chart a little lower, and I'm just going to ask you to pretend that in this location where I have the red line, let's pretend that we have a UFO. Okay, let's pretend that's the case, which is not. Okay, but I just want to make sure you understand how we're going to do it. And then following sessions that we get together, we'll be able to do it together, you know, with other examples, because we could do it KRE, but for education purposes, is not ideal. Okay, so therefore, I would like to propose to kind of improvise it. Okay, so let's say that we have this. Okay, so we have this. You have a red UFO located at this price. Oh. style, fill, color. Okay, so I'll do it half transparent, something like that. So let's say we have a UFO at this price level, okay, and therefore we are planning to, okay, same idea as we had before. So what we're planning to do is we are planning to buy a call, okay, we are planning to buy a call instead of going long shares of MasterCard. The question is, if we were to do that, which is the one we would do? And remember, we need to answer two questions, which is what expiration date and what strike. The easiest one to answer all the time is the strike, because you look at this number, 221, and you just go take a look at the option chain to see what's available. Okay, so let me reset the option chain because I lost the internet connection, so I had a problem, and I want to make sure I got all good on my option chain. So I'm just restarting it. Okay, just restarting here. We will load the option chain for MasterCard. This will show us out of all the options available in the world for MasterCard, we'll get to see the whole list, and then we'll be able to decide which one. So when you look at the strike, okay, normally if 221 is the number you want, and let's say we were to use April, you will look at the nearest number, which in this case would be 220. Okay. Now again, we need to look at expiration date first, even though the strike is the easiest, because other expiration dates, you see, they may give you 222.5, 217.5. So you may have more choices depending on the expiration date. You may have more strikes. So again, the key is not the strike. The key is to start with the expiration date. That should be your first step not to waste time. Okay, so what are we going to do? Well, first, we need to look at when are earnings. Okay, and second, we need to look at when is my TTT. Okay, this is what I need to look. The earnings, piece of cake. You just come into your briefing.com website, type MA, hit enter, and you can see the earnings date for MA is May 1st. Okay, so now we know it's May 1st. So I'm just going to type it here. So we have it in front of us. So it's May 1st. Okay. What about the TTT? Well, now I need to teach you a new calculation that we haven't done before. Okay. So we're going to have to do an assumption. Okay, we're going to have to do an assumption. Okay, you guys may be familiar with a technical indicator, which is known and used by everybody out there. Okay, where this technical indicator is known as, I don't have it active, I need to activate it, is known as average true range. So we can do this in multiple ways, and further later in time when we get more advanced, I will show you a way to calculate it actually to anticipate the movement based on the price of the option. So we'll look at that too, which is more advanced. But right now, if you were to look at a basic ATR, the current value is 265. Okay, the current value is 265. So let me write it down. Okay, ATR equals 265 per day, because I am looking at a daily time frame. Okay, so keep that in mind. It's per day because I'm looking at the daily time frame. So 265 means that as an average, that stock moves $2.65 per day. But when talking about time to target, we are not going to expect that from our entry to the target, the market is going to move in a straight line at a rate of $2.65 a day, $2.65 a day, $2.65 a day. We're not going to expect that. We're going to expect more something a little bit like a zigzag, where move up a little bit, right? And then retraces a little bit. And then what? Move up again, and then retraces, etc., etc. So this would take certain amount of time, and we need to count on ups and downs, because price doesn't move in a straight line in most of the cases. So a rule that we could use, so TTT calculation, okay, a rule that we could use, and actually I should be typing this on the Word document, so that we'll keep that for future reference. Okay, so when calculating our TTT rule, TTT calculation, what we'll do is that we will assume that every week, which equals 5 trading days, the market nets 1 daily ATR. That would be the assumption. In other words, if you had one up day, one down day, one up day, one down day, and one up day, okay? So Monday, you went up. Tuesday, it went down a little less. Wednesday, it went up. Thursday, it went down. And Friday, it went up again. Well, you would have 3 ups and 2 downs. So this is plus 1 ATR, minus 1 ATR, plus 1 ATR, minus 1 ATR, plus 1 ATR. If you do the math, okay, so we are kind of netting plus 1 daily ATR in 1 week. Okay, so that is what our calculation suggests. That is how we're gonna do the TTT calculation. Okay, so now the question is, okay, so how much room I have for this market to move? How much distance I have from my entry to my target? And if the target is 239.74 and the entry is 221, let me say it again, 239.74, and the entry is 221.22, as you can see right there, right? So if that's the case, we are talking about, okay, room for movement, it's 1852. So we will look at room for movement, which is the distance from entry to target. That's the room for movement, okay? How much room for movement we have. So what would you do? Well, you would take that room for movement, okay, which is, I erased it by mistake, but it was 1852. Okay? So you would take the room for movement divided, okay, by the daily ATR, okay, which is 265, correct? 265 per day. So this divided 265, that tells you that we are counting on 6.98 weeks, okay? So 1852 divided 265, okay? That means that we are counting on 6.98 weeks to get to the target, assuming that you got one up day, one down day, one up day, one down day, one up day, okay? And how much is that? Well, if you multiply this times 7, because every week is 7 days, you end up with 49 days is the time to target. Okay? Times 7 equal 49 days. It's the time to target. So the expression that we want to use cannot be less than 49. It has to be 49 or more. Okay? So again, coming back to the Word document, room for movement divided by ATR all of these times 7, all of this is TTT. Okay, that's your time to target. So what do we know? We know we have a time to target of 49 days. We know earnings is May 1st. So now by looking at the table, April 18 is not the one that incorporates May. May 17 does incorporate May, and May 17 got 82 days to expiration. So that is the expiration date we're going to use. So you're going to use May 17. That's how you decided. Okay, so we concluded that we're going to use May 17, 2019 is the expiration date. And when it comes to strike, now that I know it's May 17, I will expand my list. And now I'm going to look at the nearest number to 221.22, which is 220. So we now know the strike will be 220. Okay, we guessed it before, but now we know. Why? Because now we have seen the proper expiration date expanded, and we do have the 220. So what are we going to do? Well, instead of buy a call, instead of going long shares of MasterCard, so I would like to refer you to buy the May 17, 2019 call. Okay, which is the 220. So we're gonna buy the May 17, 2019 220 call instead of going long shares. Okay, so that's what we're gonna do, and this is now, it's decided. Okay, so that's it. We have it. So what's missing now? Well, if you remember what we said before, okay, you need two things to be able to do your options trades. First of all is which one? We need rules for that. And then we also need the rules for when do I get in and when do I get out. You also need rules for that, okay? Which is based on your trading plan. In this case, it's going to be the UFO. So when it comes to the green UFO, you buy the 220 call that expires in May. And when it gets to the red UFO, then you sell the 220 call that expires in May. And by using May, you have given yourself enough time to target. And on top of that, you're using an expiration date where the earnings effects are built in, which is going to help with offsetting the problem with the time decay. And on top of that, you use the strike, which is the optimal strike. It's going to make the trade a little pricey because it's the at-the-money strike, but you know what? Not too bad. 11.90 times 100, it's $1,000. Okay, well, you can be in this trade by spending 11.90 times 100 is $1,190 instead of purchasing 100 shares at 221.22, which is $22,000. So instead of $22,000, you can be in the same trade using 1,190. That is 18-to-1 leverage, which is okay. Okay, which is okay. And we'll learn to do this better. But this is the first set of rules in these option sessions that we have been doing together. This is the first set of rules that I'm sharing with you. So now you know how to buy a call, even though we'll add more stuff to make it better and better. Okay, but now we know the basics. Okay, good. So, Carl, this would be the time for you to ask your question. You had a question earlier about calibration. So maybe we can conclude the session today with your question, and then we'll call it a day, and we'll continue diving deeper into options trading and so on. So just wait for your text on the comments box. Carl, if you could copy and paste, that would be very useful. Okay, I'm just gonna wait just a little more in case you need more time. And by the way, for everyone else, how is it going so far? everybody? I know that Chuck had to leave, so I know, Chuck, you had a Forex question. If you're watching this recorded, please send the question in an email and we'll take care of it, because I know you had to go. But Carl, I believe you are with us, so if you are with us, please go ahead and type your question. And if you had to go as well, so if you're watching this recorded, you can certainly send an email too. Okay, and everyone else, how is it going? I see multiple comments here on the various charts. Good. So here is Carl's question. Here's Carl's question. So I'll get this on the stream so everybody can read. So what does the percent figure mean, and how do you select the correct calibration? Okay. Good. So yeah, I totally get your question, Carl. This is a very, very good, very, very important question. And what I want to do, if you don't mind, just give me a second, because I should have a easy to find. I should have a couple of links that would answer this question with a lot of detail. I'm going to give you an answer now, of course. But I would also want to send you home with a couple extra links that could be useful to you. So I would like to ask you for just a second. Yes, I found it. Here we go. I have it. So guys, I'm going to put it on the screen, and I will put it on the screen. And you know, the YouTube URLs are a little uncomfortable, so you may want to take a screenshot so that way later on you have it, okay? Because what I'm pasting on the screen is going to be a couple of URLs. Notice those are two of the YouTube videos that we have done, where we explain the whole calibration process with a lot of detail. And I have just pasted there that starting on the minute 21 all the way to 31, and then the second session from the minute 50 to 1 hour 32, which means that we spent 42 minutes talking about calibration on that video. So that was a pretty impactful video. So you can see a lot of detail there, and it would be very helpful for you to watch this, okay? But I want to give you an answer to your question before we go. So let me switch my chart to Euro USD, for example. Euro USD. Okay, here we go. So we have the Euro USD here. Good. So for example, if I load the Euro USD in the daily time frame, it's telling me 57.8. So your question is, what does that mean? And the second question is this good enough? Okay, those are your two questions. If I got you right, okay? So first of all, what this means is that based on the amount of data that you have on your screen, which depends on two things, depends on the amount of bars you have loaded, okay? The beginning date of your chart, if instead of number of bars, you went for beginning date, right? And the ending date, okay? Depending on the beginning date, ending date, or the amount of bars you have on the chart, which in the end is kind of the same thing. So depending on the data loaded on your chart, okay, let's make an example here. So for example, from 1/1/2017 to 12/31/2017. So that would be a 1 year of data going from January to December. So if I do that and I click OK, so 59.52%, that number represents the UFO performance stats for that 1 year period. Okay, so what the numbers means, I'm going to explain it right now, but before I explain what it means, you need to understand that this number is linked to the amount of data loaded on your screen. So if instead of looking at 2017, I look at 2018, so I look at January 2018 to December 2018, So that's 1 year of data, but it's the next year. And I click OK. You will see how this number changes. Why? Because the data, the historical data that is being used for this calculation is different. Okay, that's what it means. If I was to add more, so instead of 1 year, I add 2 years. So I'm going to go from 2017 to December 18. So this is the whole 17 and 18 years. Okay, so it's 2 years in a row, and I click OK. So again, the number will change again. Why? Because I have a different quantity of data on the screen. Okay, and when calibrating, okay, whatever this number means, what you want to see is you want to see the number quite constant. So you have seen that no matter what I have done, I've been ranging between 55 to 60%. It's a constant number. I didn't see 25%, 78%. I didn't see such a crazy range. I've seen a pretty constant number. You should also look at narrow ranges of time. So for example, what if instead of looking at 1 year or 2 years, what if I look at, I don't know, 10 years of data from 2008 to 2008 to 2018, right? 59. Notice how the number is constant, right? Anywhere between 55 to 60. What if I look at 6 months? Okay, so I went 10 years, 2 years, 1 year. What about 6 months? Okay, so if I go 6 months, that would be June 1st, 2018, for example. Okay, so that would be 6 months. So what happens to that? 52%. Okay, now it varies a little more. Could be reasonable as well because 6 months in a daily time frame is not too many bars. Okay, 6 months in a daily time frame really goes from here to here. Okay, that is 151 bars. This is not even relevant for statistics. Is that making sense? For statistics, you want to have a good sample. Okay, so in the case of a daily time frame, 6 months is not enough. But what if you are doing this in a 5-minute time frame? Well, 6 months of data in a 5-minute time frame is relevant. So if you were to do this in a 5-minute time frame, and you are looking at June 1st, 18 to December 31, 18, that's 6 months of data, right? So what number we get? Okay, so it's calculating 70%. And by the way, you will normally see lower time frames produce a higher number, which means I need to explain what the number means. I'm getting there. What if you, instead of looking at the 6 months, what if you were to look at 1 month, for example? Okay, so 12 December 1st to December 31, that's 1 month. It's not a lot, but in the 5-minute time frame, it's significant. Well, notice how the number is constant too. So again, long story short, you want to see constant figures. You want to have, the figures will fluctuate, obviously. Markets not always behave the same way, so the statistics will represent that. But you want those fluctuations to stay in a range, because if those figures were to change dramatically, it would actually mean that your methodology only works in certain conditions. And therefore, you have a methodology that depends on how lucky you are, instead of having a methodology that provides statistical results that are constant, which means that now you have something reliable that you could lean against and that is likely to support you. Okay, so that's the first comment I wanted to make before I even explain what it means, is that you want this number to be quite constant. Okay, so please watch those videos I just pasted on the screen, because it will really help you to understand better how to do the process. But then the first question that you had was actually, what does that mean? What does these numbers mean? Well, this number means that in every chart at any moment in time for that collection of data loaded, you had red UFOs and you had green UFOs. You had both, red and green. So what the number represents, what the number measures, is how often, when the market comes to the red, it turns and drops all the way until it hits the rival green UFO. Or how often it is that the market drops into the green UFO, and out of the green UFO, it rallies out and hits the rival red UFO. So in other words, how often those UFOs work versus how often those UFOs fell, and the market does not react to the unfilled orders because the unfilled orders were canceled or taken away. Okay, that's what this is kind of measuring. And it doesn't mean, let me give you two angles. This is what it means. Okay, so hopefully I made my point. This is what it means. But let me tell you as well what it doesn't mean. So what it doesn't mean is how often you will be profitable. It doesn't mean that. Why? Because you are not going to take all the UFOs on the chart. And if you don't take all the UFOs on the chart, then it means that your number, your results in your account may be a little above these or a little below these, depending on how you trade. So on the get-together sessions when we trade together, you may have seen me combine the UFOs with moving averages, combine the UFOs with fibs. You may trade the UFOs with Ichimoku clouds. You may trade the UFOs with fundamentals. You may trade the UFOs by, putting it together with the gaps. You may trade the UFOs, using the news. You may trade with the, you name it. You get my point. So depending on your methodology, and therefore you will ignore some of the UFOs and you will execute only a few of the trades, then your result as a trader will not be that number exactly. But as long as you're using UFOs, statistically, as long as you keep trading, you should get close to this number, because if you had taken every single trade, this is what the statistics show you. Is that making sense? But again, make sure you understand this is not going to be the performance in your account after 1 year. It may be way more, it may be way less, depending on the amount of trades you take. When do you take profits? Do you take one target? Do you take 5 targets? Do you enter with the trend? Do you go against the trend too? So there are many, many things that will impact your performance. Okay, so this is, if you close your eyes and you forget about the world and you had taken all the trades with all the UFOs, these measures how often price bounce from the green UFO and reach the rival red UFO, or how often price bounced moving down and dropped from a red UFO until it reached a green UFO. That's what this means. Okay? Anyway, hopefully this was useful, guys. I want to have one little more apology at the end of the section, guys. You guys have been really patient with the few technology issues I had today, so I really appreciate your patience. It's always a little uncomfortable, and on top of that, we finalized the session a little late because of that too. So thanks so much for being there, guys. And keep up with the good work. Some of you are sending amazing trades. Some of you are sending amazing comments and big aha moments, big eye openers that you're having thanks to the AutoUFOs. So keep the good work. Okay. For the ones watching this recorded, typical question that many of you ask many times is, how do I get the UFOs? Very simple. You go to our website, www.tradewithufos.com. Okay. You scroll down a little bit and you click subscribe. That's it. Okay, and you follow the process and you're in. Okay, very good. So guys, loving spending this sharpening time all together. We'll see you soon. We'll see you tomorrow. Tomorrow we have get together for short-term trading. So see you tomorrow, my friends. Enjoy the rest of the Sunday and be ready for tomorrow, guys. Trading time. Bye-bye. Take care, everyone.